Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to be covering 12 companies that I call the Dirty Dozen, as you can see here on my portfolio review. I've organized these by order of earnings yield, highest to lowest. I can do that just by clicking these columns. And my minimum threshold for an earnings yield is about 6.5% to 7%. And you'll see that each of these companies that I've got here have offered me an earnings yield above that 6.5%. Another criteria I used to put this list together was dividend yield. Here I've got dividend yield from lowest to highest. I also looked for companies that were paying at least a 3% dividend yield. And the other thing I want to point out is I didn't really include any REITs or other kind. These are just strictly traditional C Corps, as you would call them. So I'm going to go through this list, and I'm going to do it in order of alphabetic order as I go through it. But I do want to tell you I'm going to go through the list quickly because I'm covering so many companies here. But the idea behind this presentation is to be looking for companies that are attractively valued in today's overvalued market. Therefore, in order to establish the proper perspective, let's take a look at the S&P 500. The orange line on this graph represents a PE ratio of 15, and the blue line represents a PE of 18.3. I'm going to shorten this graph a little bit because I want you to notice this real high period of valuation where you had PEs up here in the high 20s, and you'll notice as that led to poor performance for the next several years. So I'm going to lower this to a 17-year graph, and what I want you to notice now is you've got a PE, actually I'm going to lower it to 15. You've got a PE of 15 to 16 here. That's kind of the normal range of fair value for the S&P over long periods of time. And you can see the market's above that 16 PE ratio line. The current blended PE of the S&P is 19.2 and the current dividend yield is 1.8. So this is a clear picture of high valuation for the market, higher than normal or historical valuations, at least since 2005. So the idea here is I'm looking for companies that are fairly valued in this overvalued market, and I'm looking for higher yielding dividend paying stock. My first candidate, I'm going to look at AbbVie, which was a spinoff from Abbott Labs. And what I want you to notice here that the normal PE and the historical PE are both at around 15, 15.1 and 15.2 times earnings. So if I take the normal PE off, you see the orange line. When I put both lines on, they're virtually the same. So that's a fair value for this stock. It's currently trading at a blended PE of 13.6 and as a result offers a 4.1% yield. Now, one of the things about exercises like this is what I'm doing is I'm looking for stocks that are good yielding stocks, have good dividend records. Since AbbVie has been paying a dividend, you can see that they've increased it very nicely since 2013, averaging over 13% a year increase in their dividend. Their track record has been exceptional relative to the S&P 500 over this time, and this is from December 2012, right after their spinoff to current time. You can see they've paid significantly more dividends, they've produced significantly more capital appreciation, and an annualized total return of 22% versus the very exceptional return for the market. Remember now the market's overvalued now of 13.9. But the point is the stock got overvalued here, and now it's come to where it's below these normal fair valuation reference lines. Now I'm going to do this very quickly. I'm going to take a look at operating cash flow. I want to see how well the dividend is protected. And as you can see, the company is covering their dividend with operating cash flow. Got a little close in 2014. And I'm also going to look at free cash flow to also again determine the company has ample free cash flow to cover their dividend. The company does have a lot of debt. However, it is A- rated. And it's got a really exceptional growth rate, over 12% on free cash flow, and their operating earnings growth, as you might recall, has been 15%. Now, I've been accused in several of the comment threads of the articles that I've done of being always backward looking. And the thing is, fast graphs are not just backward looking. Now, I like to look at the historical operating results of a company, because if I take price off of this graph and just look at the earnings record and the dividend record, you can see that this company has been a very consistent grower. When I put the price on here, this gives me a perspective of whether I'm buying it at a fair value, but I also have forward forecasts here. And these forecasts are being offered by leading analysts that are following the companies and analyzing them, attending their investor meetings, etc. Now, there are 20 analysts forecasting 40% growth for this fiscal year, which ends in December. There are 22 analysts forecasting 14.67, and then it drops down to 16 analysts forecasting 10.9. And this is typically about as far as I like to go. But if you look at this stock trading at its normal PEs of between 15 and 16 that I was showing you earlier, at the 15 PE, that would represent an annualized rate of return of over 30% a year through 2019. And if I go out here to 2020, again, a little further, it still would be a 24.67% return. Now, another thing that I like to check when I'm looking at companies like this is how accurate have the analysts been historically. And I'll give you the quick summary. This company has been very easy for these analysts to forecast, probably because the company gives good guidance or fair guidance, and the analysts are able to come up with pretty good estimates. So I've got a lot of confidence that these estimates might be relatively close to what the company actually does achieve going forward. All right, so I want to make it clear. I'm looking at the past to see how well the company has operated, but I'm also looking closely at the future, and I'm looking at how well the dividend is covered, because these are primarily dividend stocks. So now that I've kind of established that, I'm going to go through this list and speed things up a little bit. Let's look at Cummins, and Cummins, of course, is the diesel manufacturer. And let's look at its long-term record. You can see that its dividend record is exceptional. There have been periods where they've frozen their dividend, but over the long run, they've increased their dividend by over 16%. This is going back to 1999. They've dramatically outperformed the S&P 500 in both dividend income as well as capital appreciation over this time. But I do want you to notice the company does have moderate periods of cyclicality. We saw cyclicality during the Great Recession. We saw significant cyclicality during the recession of 2001. And the company maintained their dividend. They did not freeze it there, but their operating results suffered during those recessions. So that's something to consider when you're looking at a company like Cummins. Operating cash flow, significant coverage of their dividend, as you can see, even coming out of the recessions, as well as their free cash flow. Again, I'm utilizing these metrics here to take a look at how well the dividend is covered. They didn't have enough free cash flow to cover the dividend during the recession, but they did during the Great Recession, although their free cash flow got weak. These are things you should be considering when you're looking at companies like this. Now, from a valuation perspective and looking forward, not looking in the rearview mirror, but looking forward, the leading analysts expect this company to grow earnings at 25.7% this year. There are 19 of them. They expect that to be followed up by 11%, and then they do expect that cyclicality to manifest to be a drop. But again, if you go out to these next couple of years and you just expect this company to return to a normal PE of 15, you've got some tremendous opportunities. Through 2019, your annualized rate of return could be over 40% a year. And again, what I'm liking here is the valuation of this company has fallen. You can see the price is beginning to recover a little bit. And these rates of return going forward are predicated on these low valuations. Now, you can also utilize fast graphs and go into external links like Seeking Alpha, for example. You can go into their research. You can look at a company's most recent earnings reports and see, what the company has done. You can see that they topped their revenue estimates and their July 31st report. They also missed earnings by 34%, but they beat on revenues, and so the stock is down today. But the point is, the valuation is already low. The current PE is 11.4 blended, dividend yield 3.3% with some opportunity for dividend growth. So moving on, let's take a look at CVS. This is what I call the Amazon effect. You can see that CVS's price has followed its earnings. You can see the company's operating results have been excellent historically. They flattened a little bit this particular fiscal year for 2017, only had 1% growth, but analysts are expecting them to begin growing again. The price was really overvalued. That flattening of earnings really caused a reversion to the mean, and I think it's overshot it. This stock is trading at less than 10 times earnings with a 3% dividend yield, and this is on the high side of the dividend yield that this company has ever offered, at least over these last 18 to 20 years or so. The company's track record is virtually a dead heat with the S&P, even considering these low valuations, and that to me is what makes this attractive, as you're looking at a very low valuation here. Again, analyst expectations are for good growth this year, followed by moderate growth next year, and then 8% the following year. So what you have here is an opportunity to generate significant annualized rates of return over the next couple of years, assuming this company goes back to a PE ratio of 14 or 15 or so. Again, looking at the analyst scorecard very quickly, this has been a very easy company for the analysts to analyze. They've literally met analyst estimates 100% of the time, both when analysts were making a forecast 1 year ahead and 2 year ahead. So this is, a company that I think is worth taking a closer look at. General Mills is a very interesting story. You can see that it trades at a moderately high premium valuation quite often by the market. That's the blue line here. But it also comes back down to to this 15 PE many times, which it did. It got significantly overvalued in July of 2016. We've had a significant correction. It is now at an attractive valuation, offers a 4% dividend yield, and can be bought at what I would call a fair value PE of 14.6. This is not a real high growing company. Analysts are only actually forecasting negative growth this year, which I might explain the low valuation, but they do expect to follow that up with 7.5% and 4% growth going forward. So once again, we have a decent rate of return, 9% annualized over the next couple of years, maybe 8.5% going out a little forward. But what you do have here is a high yield. This would be primarily attractive for those that are looking for as much income as they can get on their current portfolio in order to meet their current needs. So we've got General Mills at a 4.3%, but I also want you to notice the effects of high valuation. So this is attractive, but not necessarily a screaming buy like some of the others. Here's the Interpublic Group. You can see this company has been very cyclical historically. Since the Great Recession, it's had really an excellent track record. Earnings have grown at over 23%. The market has valued this company at about a 17.9 PE. The dividend, they started paying their first dividend in 2011. You can see this is one of the highest dividend yields that this stock has offered. Again, primarily a function of the stock being undervalued here today. Again, looking at operating cash flow for dividend coverage, which is my primary objective when I'm looking at operating cash flow. The company produces more than adequate operating cash flow to cover their dividend, and they also produce adequate free cash flow to cover their dividend. It got their free cash flow payout ratio was pretty high in 2016, but it's recovered and is expected to be quite strong. Free cash flow generation is expected to grow by 5% this year and over 11% in 2019. However, the company is only an $8.5 billion company. It only has 33% debt, but they're only a small group of analysts following the company. From a standpoint of how accurate these analysts have been with their forecasts, this one has a pretty shady record. Analysts have missed estimates on this quite often. That would be something to take into consideration. So these very high forecasts here may or may not come to pass. But once again, the stock looks worthy of looking at now with a 14 PE, 13.8 PE, and a 3.8% dividend yield. The valuation would indicate that this might be worth taking a closer look at. My next candidate here is Meredith Corporation. This company just made a big acquisition of Time Warner's assets. The company is trading at a 13.9 PE. It offers a 4.2% yield. But what's really interesting about this company is the analysts are forecasting exceptional growth going forward, and this is what attracted me. Valuation is okay or attractive at 13.9 times earnings. Dividend yield is attractive at 4.2. But this is where you'd really want to discover whether or not you believe these analysts' forecasts of 60 and 58% growth over the next 2 years is reasonable or reasonably accurate. The analysts have been on the money with this company in every year going forward. So this could be one that's really an exceptional reacceleration. This is more about forward looking than historical looking, by the way. So it's a excellent looking research candidate. Omnicom Group is another advertising company. If you look at the long-term record at this company, the market has had a penchant for valuing it highly. I want you to notice when valuations get high, these stocks tend to perform very poorly over the long run. But right now you can buy this stock at a 12.5 PE with a 3.6% dividend yield. I think it's extremely attractive on a valuation basis. It's reasonably well followed. There are 16 analysts forecasting 10% growth this year, and then followed by 3 and 6. But if this reverts to the mean, you've got the opportunity for double-digit 22% annualized, and going out to 2020, 16.7% annualized returns. Once again, I'll just do a quick summary here. You can see the analysts have been on the money with their forecasts on this company. So it's another one that has a pretty good record of analysts forecasting it. Principal Financial Group, a little bit cyclical during the recession, but again, this was not, this is a life and health insurance company. They did cut their dividend coming through the Great Recession, but you can buy them at a 10.5 PE with a 3.8% yield. And their normal PE has been about 12, and I would value this based on a 12 PE, not necessarily the 15. So coming down here, if I look at this 12 PE, the annualized rates of return for the next couple of years would be as high as 23% going out to 2019 and 17% going out to 2020. I want to make sure you picked up on what I did here. The market has a tendency to value this at a lower valuation than a lot of the other companies I've showed you. Even though it's an A- credit rating, it only has 19% debt. I would be conservative and figure this company going back to a 12 PE and not necessarily back to a 15 PE, which I think it's worth. I did throw in Royal Bank of Canada here. This is another company with an excellent long-term track record. This is in US dollars. This is the co-listed New York Stock Exchange version. I do want you to notice that it did have some cyclicality during the recession. The dividend record is actually a little better than this. If you look at it in its Canadian dollars, there's some exchange rate issues here, but you can see they've produced a prodigious amount of dividends and they've dramatically outperformed the market. And this is an opportunity to buy it with a 3.7% dividend yield. Last year, the dividend yield was 3.5. This is a very attractive investment with at a 12.5 PE, which again, I want you to notice that that's approximately what the market has historically valued this at. So if I'm looking at the future here, I would once again maybe focus on a 12 to a 13 PE ratio, and so you're looking at high single digit to low double digit returns, but it's a AA rated company, very high quality. Ignore the fact that it has no debt because debt on banks is their product and it's not reported the same. I'm going to take a look at JM Smucker here with my next candidate. This was excessively overvalued in 2016. You can buy it at a 13.6 PE. It's currently offering a 3.1% dividend yield. Forecast growth going forward is for about 5%. That would, again, imply if the stock goes back to a 15 PE, double-digit rates of return for the next couple of years with a nice dividend yield. Company has 36% debt. Their earnings scorecard is quite good. It's not as impeccable as some of the ones I showed you. Analysts have missed the one-year forecast about 17% of the time, but the companies also beat it 33% of the time. And ironically, their two-year forecasts have been about 100%, but now keep in mind that the two-year forecasts are given a 20% margin of error. Anyway, I've written articles about this company before. I think it's very attractively valued here for the long-term ownership going forward. The next one I want to take a look at is AT&T. AT&T, however, I would only shorten this graph to the last actually 11 years since SBC Communication or Southwestern Bell bought them. This is how AT&T's recovered. There's a lot of controversy on that stock. You can buy this stock at less than 10 times earnings with a 6% dividend yield. It has 41% debt. They did increase their debt rather dramatically with some acquisitions that they've recently made. The company's track record on dividend yield is exceptional compared to the S&P. It's been underperforming the S&P recently, and that's because the valuation has gotten so low. But this company has a lot of value with a 6% yield at this level. So I'm looking at this as an extremely undervalued situation. And then a counterpart or a similar company would be Verizon. It also offers the opportunity to buy the stock at a low valuation, a 12 PE with 4.6% yield. Its track record has not been very good relative to the market, other than its dividend income has been significantly higher. But I want you to see that's primarily because the stock was so overvalued back in 1999. If I shorten the time frame here, then it still underperforms the market on capital gain, but it outperforms it on dividend yield. So Verizon and AT&T, in my view, are income stocks, not necessarily growth stocks. So the point I wanted to make with these, I was asked by people after I did the article on overvalued stocks recently to show some undervalued stocks. These are higher yielding dividend growth stocks. With my next article, I'm going to look at additional dividend growth stocks with lower yields that have more growth potential than a lot of these candidates have. Anyway, this has been Chuck Harlow. If you found this interesting and you find fast graphs attractive, you can contact us at 813-960-9600 or go to our website, www.fastgraphs.com, and learn more about fast graphs and how it can help you be able to make smarter, more attractive investment decisions. The primary idea behind this presentation was low valuation is an opportunity for long-term investors to buy good companies at attractive values and end up making long-term returns, but not necessarily short-term returns. Thanks for